Today, I want to talk about pre-qualification and the 3 key things to getting pre-qualified for a mortgage. Each of these are what me as a lender analyze in various capacities when it comes to pre-qualifying you for a home loan. And I get clients coming to me all the time saying, there is no way I qualify for a loan. And then I start asking them the questions and I'm like, well, yeah, you do. So I want to go through these key areas to qualifying for a loan so that you as a buyer feel more confident when thinking about purchasing a home. Before we dive in, if you have not done so already, I'd love for you to give this video a thumbs up. And while you're down there, please subscribe to my channel. It helps me reach more people just like you, and I really appreciate your support. Before I talk a little bit about the 3 keys to qualifying for a mortgage, I first want you to understand the difference between being pre-qualified and pre-approved. At the most basic level, they're both types of mortgage approvals, and they refer to the steps that I as a lender take in order to verify that you can afford a mortgage. However, there are a few key differences. A pre-qualification is generally the first step in a mortgage process, and it relies on self-reported information that we collect in order to estimate how much house you can afford. So let's double click on the fact that this is an estimate. As the information has not been verified by pulling your credit or reviewing financial documentation. And while a pre-qualification can give you a ballpark estimate, it's much less reliable than a full pre-approval. With that being said, a pre-approval is a much more official step that requires us to verify your financial information and credit history. Documents required for pre-approval include things like your tax returns, pay stubs, bank statements. This means a pre-approval is a stronger sign of what you can afford, and it adds more credibility to your offer than a pre-qualification. So now that that's clarified, let's get back to the 3 key steps to qualifying. Step number 1 is credit. When we're chatting with clients for the first time, we'll always ask, well, how's your credit? We do this for a few reasons. First is that we want to get a gauge of what type of loan program we could be looking at. And 2, we want to make sure that you meet the minimum product requirements. What I mean by minimum product requirements is that different loan programs have different minimum credit score requirements. Additionally, different lenders even have different score requirements for the same products. So you could be denied by one lender because they said your score was too low, but approved by another lender because their requirements were slightly different. It's very important to note that as we start talking about your credit score, your credit history comes into play as well. Meaning your credit score could meet the minimum requirements, but you may run into issues if you've had, say, late payments in the last year, or you're not paying something right now, so there could be red flags. So it's important for you to know that it's not just about the score, but the transactional history. All right, so number 2 is your income. Income actually ends up being really frustrating for clients, sometimes because you could tell us that you make XYZ. But once I look at the loan guidelines against how you're actually paid, you may only make less than that. Let's just say, for example, you've been working at the same company for 10 years and you were salaried, but you just got promoted 6 months ago, and now you're 100% commission. You're making twice as much money, but I can't use it because now it's variable. And you're like, what the heck? And I get it. But lender guidelines for commission is typically a minimum of a 2-year average, sometimes as little as 1 year. And self-employed is usually the same. We typically want a basis of 2 years tax returns. Again, we can get a 1 year, but it depends on your credit history. Honestly, the only income that you and I will look at exactly the same is if you're salaried. So there's just a few ins and outs that will sometimes pop up when it comes to your income. The third key component to qualifying is your assets. What do you have in your bank account? When filling out your loan application, you do not need to list all of your bank accounts. You only want to list the accounts that you plan on using for the transaction. So what you're going to use for your down payment, your closing costs, and anything else pertaining to the actual closing are those accounts that we need. Oftentimes, clients feel like they might not be ready to pull the trigger because they don't have enough in their account that day for closing costs. But in today's market, I'm seeing sellers paying for closing costs for a lot of buyers. And that's just something that you can discuss with your real estate agent when they're writing or negotiating your contract. So don't let that be the reason why you don't try to get pre-approved. There are also some loans that may require you to have reserves. I mean, simply put, that is a required amount of money that you need to have in the bank account after the transaction closes. These loans are typically investment properties, second homes, or jumbo loans. So these are the three loans where I would recommend clients list either their stock accounts or their 401ks. You don't have to liquidate them. I just need to show that you've got them for reserves. Reserves could also sometimes even be the key to getting your loan approved if you've got some credit hiccups along the way. Well, that's all I have for you today, guys. If you have any questions, please start the conversation down below in the comments, and I'll talk to you soon.